Dividend investors love real estate investment trusts because they give you easy exposure to actual cash flowing properties without having to physically manage the properties yourself, which can be a hassle. The thing is though, when interest rates go up as they have these last couple of years, it becomes more expensive for REITs to borrow money, which is a big deal since they often need to borrow money to buy more properties. That's how these businesses grow. So what happens is when interest rates go up, real estate investment trusts have to pay more interest on their loans, and that eats into their profits, which means that there's less money left over for the dividends. Plus, when interest rates go up, investors might prefer other investment vehicles like bonds or savings accounts, which become more attractive with higher interest rates. So they might ditch REITs in favor of those other things, which causes the demand for REITs to drop. And when demand goes down, share prices tend to follow. Having said all of that, REITs have just been on the down and out lately, but it's not all bad because lower share prices means better buying opportunities. And in this video, we'll be talking about 3 REITs on the down and out that all look like great buys right now. All of the ones we're talking about today have seen substantial share price drops in the last year, and they're all dividend growth behemoths with a track record of increasing their dividends pretty aggressively, starting with this first one here. So VICI Properties, guys, is looking pretty sweet, and this is a really fun company. They focus on experiential real estate, which can include things like golf courses, water parks, and theme parks, along with hotels and resorts, which is what VICI is most known for. They own many of the properties on the Las Vegas Strip, including the Venetian, the Mirage, which will soon become the Hard Rock. They own the MGM Grand, Park MGM, Luxor, Mandalay Bay, New York, and my personal favorite, Caesars Palace. And yes, we're talking about the real Caesars Palace. But anyway, in general, VICI has a really unique portfolio filled with one-of-a-kind properties, especially the ones they have here in Las Vegas. And as someone who lives here in Vegas, I can tell you there is always something going on here, and there are so many reasons why visitors are constantly flocking to this city. Whether it's sports, entertainment, shopping, dining, gambling, there's no other city in the world quite like Las Vegas. Anyway, taking a look at VICI's share price performance, like I said, this one is on the down and out. And in the last month, they are down 2.7%, so seeing a little bit of a drop there, but year to date, they are down a lot more. They're down 9.13%. And if we zoom out over the last year, they are down closer to 15%. So across all time periods, VICI is seeing some red. And even though the situation for the share price just keeps getting worse, the dividend stats have never looked better. VICI Properties is double trouble in the dividend department. They're not quite a triple threat, but they are on their way there. Looking at the stats here, first and foremost, starting with the forward yield, this is coming in nice and high at 5.74%. So you'll be generating some nice cash flow investing in VICI Properties, but also, you can expect some pretty solid dividend raises as well. They are also a really aggressive dividend grower with the 5-year dividend growth rate coming in just above 10%. I like to see that. That's what makes them double trouble in the dividend department here, but they've also been growing this dividend for the last 5 years, so there's a bit of consistency there, and I'd be very surprised if there was something that got in the way of this continued dividend growth, so I would expect to see the dividend growth history continue to expand as time goes on. And having said all of that, I know a lot of you guys out there are VICI shareholders yourselves, so let me know, what are you doing with this company? Are you buying more shares of VICI right now? Let me know in the comments below. So guys, I think MAA flies a little bit too under the radar. This is a great stock, and it seems to be a really solid company. Now, in case you're not familiar with MAA, this company owns and operates a portfolio of apartment communities across the United States with a focus on Class A and Class B properties in the Sunbelt region, which includes markets like Atlanta, Dallas, Tampa, and Orlando. Now, MAA currently owns over 102,000 apartment units, and they're pretty selective in the markets they choose to invest in. They're looking for areas with above average population growth, job growth, and household formation. And because their properties tend to be on the nicer end, their tenants are typically more affluent and work in industries such as healthcare, technology, and finance, which hopefully means they'll have less issues paying their rent. And if we take a look at the share price performance, MAA is actually seeing some green in the last month. They're up 3.7%, so doing pretty well there. But year to date, they are still down a little bit. They're still down 3%. Not as bad as what we saw with VICI Properties, but the 1-year performance is considerably worse. They are down about 18.5%. And with this drop in share price, guys, the forward dividend yield of about 4.5% is considerably higher than the company's 4-year average yield there of just above 3%. So you're getting a much nicer cash flow return today investing in MAA than on average over these last 4 years. Now, looking at the rest of the stats here, I think MAA is a triple threat. We already talked about their high yield. We already saw that. But the 5-year growth rate's also pretty sweet as well, coming in just below 9%. So I like to see that high yield with that high 5-year 5-year growth rate, and they have some really nice consistency in growing this dividend as well. They've been making consistent raises for the last 13 straight years. Now, once again, I think NSA is another real estate investment trust that tends to fly under the radar. To be fair, though, it's not a very large company with only a $4.3 billion market cap, but they own 1,050 different properties here in the United States, and they operate in what historically has been a pretty resilient industry in the real estate sector. As we can see here across the last 30 years or so, self-storage has been shown to deliver higher returns with less volatility than all of the other industries in the sector. And while self-storage is a relatively fragmented industry with a lot of different operators, what makes NSA unique amongst them is that they actively acquire and create joint ventures with more localized regional self-storage operators, which can have multiple benefits. For example, these local partners know their areas inside and out, and that's going to help NSA better understand those markets and will help them better meet the needs of the customers in those local areas. On the other hand, as far as what the local partners get out of the deal, they get access to NSA's large-scale brand and marketing tools, which is going to help them acquire more customers. So it's a win-win situation. But anyway, looking at the share price performance, NSA is flat over the last 30 days. They haven't moved an inch, guys, but zooming out, looking at their year-to-date performance, they are pretty deep in the red. They're down close to 11%. And looking at the performance over the last year, they are down close to 16%. So pretty big drop both year-to-date and in the last year. But once again, guys, with those share price drops, the forward yield, which is looking extremely high in its own right, 6.11%, is almost 2% above the company's 4-year average yield of 4.35%. So that's a much nicer dividend yield than you would have been able to get on average over these last few years. And then once again, the rest of the stats are looking really solid. So we've got that really high yield. This is going to be the highest one of the day, actually. But we've also got the highest 5-year growth rate of the day here at about 14%. So really high yield, really solid dividend growth, and not too shabby of a dividend growth history as well. They've been making consistent increases for the last 8 years. I think this could be a triple threat. What do you guys think? Overall, I think NSA, as well as the other 2 real estate investment trusts that we looked at, are great ones to consider if you're looking to make some more additions to your portfolio. But with that, there are still quite a handful of other real estate investment trusts out there who are really coming down in share price that I think you need to keep your eye on. The first of which is EXR, Extra Space Storage, who's up about 2% in the last month. So they're seeing a little bit of green, but looking at their year-to-date performance, they're down over 10%. So a pretty big drop there. And then in the last year, they are down 14%. The next one to watch, guys, is Rexford Industrial Realty. Pretty similar ticker symbol, actually, just add an R at the front of it. But in the last month, they are down about 2%, so seeing a little bit of a drop there. And year to date, they are down a whopping 7.5%. But then zooming out once more. In the last year, they're down about twice that amount. They're down 15.5%. Another one to keep an eye on, guys, is ADC, Agree Realty Corporation, which I think is becoming one of the most popular real estate investment trusts. I see a lot of people talking about this one lately, but in the last month, ADC is down 1.4%. Looking at the year-to-date performance, they are down 9%. And then over the last year, they are down 18.85%. So pretty big drops all across the board. Moving on, guys, I haven't talked about this one for a while, but I do think you need to keep your eye on KRC. Always keep this one in the back of your mind. They're actually doing pretty well in the last month. They've seen a gain of about 5.75%, but year to date, they are still down about 9.5%. So a pretty big drop there. And then over the last year, they are down 1.66%. And then, guys, another one to watch is GLPI, Gaming and Leisure Properties, which is a company that's really not all too different from something like a VICI Properties. They do a lot of experiential real estate as well. But in the last month, they are up 1.25%. Looking at the year-to-date performance, they are down 7.6%, and then in the last year, GLPI is down a whopping 16%. Moving on, guys, few real estate investment trusts have seen as big of a drop as WP Carey. In the last month, they are down close to 5%. Year to date, they are down 11%, and look at this, guys, over the last year, WP Carey is down almost 28%. This one stings a little bit. And then last but not least, we've got the monthly dividend company, Realty Income. You always got to keep your eye on Realty Income, especially when it's getting close to $50 per share. But anyway, in the last month, Realty Income's down 1.75%. Year to date, they are down a whopping 9%. And in the last year, they are down close to 19%. And I actually just recently bought a ton of Realty Income for my portfolio, which if you want to learn more about that, then check out this next video right over here. I recently just went on a huge dividend stock shopping spree and loaded the boat on 5 different dividend stocks, including Realty Income. So click right over here to find out which stocks I bought, and I'll see you in the next one.